this generation, I find him to be the most versatile chartered accountant. You give him a topic and he is ready. In fact, any query on the Companies Act, I think if we have besides CSR, you would be, I understand, capable of answering your queries. And before this session started, we informally were discussing a lot of issues, and he is updated on the rules which were notified yesterday. So that is Anup Shah. Before he starts his session, I request meeting formal introduction.
Good morning, friends. After yesterday's hectic things on mergers and acquisition, today Anup is going to take us through corporate social responsibilities, and also I believe something has come on the rules also on that. Before I hand over the mic to him, is a brief introduction. He is a fellow member of Institute of Chartered Accountants of India. He is ranked 19th in final CA, clearing CA. He is 11th rank in India with distinction of 70% in CA, in the CA. He is a law graduate from Mumbai University. He has completed his BCom from Sydney College, and he has also done BCA course of Business Consultancy Studies from Jamnalal Bajaj Institutes. His is a hands-on experience in business restructuring, capital market regulations, foreign investments, international taxations, private equity investments, real estate structuring, valuations, accounting advisories. He's co-authored not many books like Handbook on Capital Market Regulations by Institute of Chartered Accountants of India, Wills, Success and Family Settlements, published by ICI, Laws and Business, up to 4 editions published by BCS and Income Tax Advisors. He's contributed about 170 articles and papers to several publications, newspapers. He is awarded a prize for the best features in BCA Journal for outstanding research paperwork at International Conference on Commerce and Management. He gives talks at various seminars and workshops across India. He is a director. He is holding an independent directorship in Ruby Mills, Claris Life Science and J Corp. He is also a member of International Taxation Committee of Chamber of Tax Consultants and is a convener of Editorial Board and General Committee of BCS Journal. Before I hand over the mic to Anup, may I call upon Faraz Sawla to present a memento to Anup Shah. Please take it.
Good morning, friends. A couple of months, or I guess a month ago, when Vipul Bhai called me and asked me to speak on CSR, I was wondering how much can I talk for 1.5 hours on one section. And I thought this is something which should get over in half an hour. After I ended up making my presentation, I think this would also be less. Because the kind of drafting and the kind of issues which is very become a benchmark of this company that, and doing things in part, coming out with something and then coming out with something, and then even the rules, they've been drafted in a hurry, and somebody wanted CSR to be the pilot project of Mr. Pilot, and therefore it was done in a hurry. If you look at the rules also, they are full of contradictions, and as we'll see, and this is also corporate social responsibility and also socialist responsibility which has been thrust upon corporates, and therefore the question arises, is it something which was needed? I think yes, it's a good idea. But has it been implemented in the right way? I think definitely not. Is 2%, that's what I asked the question, and that's what I leave you all with. The 2% question, is it too much? I feel yes. In fact, one of India's greatest philanthropists, Mr. Asim Premji, is on record saying 2% is a very high figure. And you may feel 2% is what? Why are you bothering about 2%? But 2% of what size are we talking about? It could run into crores of rupees for one company, and I think that's too much to be asking one company to do. And as we'll see, even if you're making losses, you're supposed to fork out 2%. So that's something which is not a very good idea. So let's go through the issues, the problems. First look at the bare text, and then also look at what are the income tax issues, because that has become the number one question. How do you get a tax benefit for doing CSR? Now, first of all, CSR was the first section to be notified with rules. What came out yesterday was the second tranche. sometime about 2.5 weeks ago, we had the first section to be notified with rule. On 12th September 2013, you had those 98 sections which were notified which had no rules. CSR was in the next one which had rules which was notified. It's effective from 1st April, that's Tuesday. And the corporate social responsibility policy rules have also been notified along with this section. Applies to whom? Now this is very important to understand who is covered. First of all, it is only corporates which are covered. So only companies, no LLPs, no partnerships and no other entities are currently covered. That's not to say that they may not be covered in future. Now let us look at the CSR of some of the India's largest profit-making private sector companies and then compare it with what they would now be required to do and then see whether they're making a deficit or actually they're spending more. Surprise, Reliance is the largest CSR spender in India, contrary to what we may otherwise think. Now its actual CSR was 357 crores in 2013. If you take what it is supposed to spend, that is 3 years average profit before tax, 2% of that, it comes to 515 crores. That means Reliance has underspent by 31%. It would now need to incur 31% more CSR than what it has been doing in 2013. Tata Consultancy Services from the Tata House, which we generally look at India's greatest philanthropist, 72% deficit. Biggest surprise, Infosys, required to spend 219 crores, and what I could gather from the annual report, and I have cross-checked it several times, it's only 10 crores. So 95% deficit in what Infosys has spent. They might have spent more in the past, I'm not denying that, but if I'm comparing 2013, there's a 95%, so 209 crores deficit as to what they were required to spend and what they have actually spent. ITC, which has the e-Chopal, again a very good CSR initiative, it's one of the lower deficits, yet 54% in the red, and Bharti Airtel 80%. So these five together have to contribute 546 crores and they cumulatively have a deficit of 78%. I think company after company, if you will check, will be in the red, and there would rarely be a company which has totaled or equaled or exceeded the CSR spending. Estimates are very wild. The press is having a field day. You have estimates ranging from 10,000 to 30,000 crores per year. That's the CSR being projected. Let's look at what it could realistically be. This is my guesstimate, okay? 2013 net profit after tax of the top 1,000 listed companies, multiply that by 2%, you get a figure of 6,800 crores. 2013 net profit after tax of the top 200 unlisted companies, multiply that by 2%, you get a figure of 720 crores. Total of this is 7,500 crores. Mind you, CSR is on net profit before tax. This is net profit after tax. Add to this the CSR from private limited companies. I think 10,000 crores plus 2,000 crores here, there should be a realistic figure. So we are looking at about 10 to 11,000 crores of CSR spending per annum. That's a very, very large figure, which is being mandatory thrust upon companies, whether you are private, public, or listed. Again, top 1,000 companies, 874 of them are covered under the CSR criteria. Top 300 unlisted public company, 296, only 4 are left out. And private limited, we don't have data, so it's not very easy to look at. So if any one of 3 conditions are met, you are covered within the gamut and ambit of CSR. So let us look at what these 3 conditions are. This is similar to, we used to have the return filing 1/6 criteria, if you all remember. This is similar, you have 1/3 criteria. Any one, you are covered. Turnover of 1,000 crores or more, net worth of 500 crores or more, and net profit of 5 crores or more. So when you're talking 1,000, 500, you yet have some small guy, 5 crores lurking somewhere. And that's net profit, which is the biggest devil of the lot, because most people are going to be covered because of that. Interestingly, these terms are not defined in the CSR rules or in the CSR section. So we need to look at whether the Companies Act defines these terms. First 2 are defined, last one, which is the killer, is not defined anywhere. What is the meaning of net worth? So you need a net worth of 500 crores or more. The Companies Act section 2 defines net worth to mean share capital plus reserves emanating from profits plus securities premium minus debit balance in the P&L account minus deferred expenditure minus miscellaneous expenditure. So this is what we generally more or less understand as the definition of net worth. There is an added explanation that it excludes revaluation reserve for obvious reasons, because revaluation is not out of reserves, out of cash, not from profit. It is generally considered to be a fictitious reserve. Amalgamation reserve, any reserve created on virtue of merger of another company with you, even that needs to be excluded. And any depreciation write back. So if you provided excess depreciation and there's a write back of that, even that is to be excluded in computing net worth. Now this is a general definition of net worth in the Companies Act and will apply even for the CSR, because CSR has not come out with its own definition on what constitutes net worth. Turnover 1000 crores or more. Now here again section 2 defines turnover to mean aggregate realization made from sale of goods, supply of services, or both in a financial year. Again, so it could be sale of goods, supply of services, or both, and both should be in a financial year. What about adjustments for trade discount, bad debts, and excise and VAT? How do you deal with that? Do you include them? Do you exclude them? I believe adjustments for discounts and bad debts should be done, and you should look at the figure after that. And correctly, the better way to show it, and this is what even the Institute's guidance note on VAT accounting says, is to show it in the exclusive method, that is show VAT separately and show turnover separately. But if you are charging an inclusive price, then turnover would be inclusive, and then in that case even excise and VAT would be included in counting 1000 crores. So how you account for it may in fact push up your CSR or may take you out of the CSR ambit. Net profit. Most important of the three. Is it net profit before tax or after tax? Very fundamental $1 million question. No answer. I believe that it should be net profit before tax, but there could be detractors. The draft rules said net profit before tax. Final rules, for some reason best known to them, have omitted it. And we know why they omitted it, to create more ambiguity. Net profit computed as per financial statements, but excludes two things. This is what they expressly provide. Profits of foreign branches, so if you have a branch anywhere, you don't include that profit for CSR purpose. And dividend received by an Indian company from another company to which CSR applies. So if you need to find out which of the companies from which you have received dividend is caught within the CSR ambit. If it is caught, then exclude the dividend which you have received from that company while working out net profit before tax or after tax. If you look at the guidance note on tax audit issued by our institute, it defines the term net profit to mean net profit before tax. That plus looking at the draft rules, I think it should be net profit before tax and not after tax. One important question which again needs to be examined, what do you do if there is any auditor's qualification? Do you adjust these figures or do you just take them at face value at what is stated in the balance sheet or P&L? Auditor says that you have booked a revenue which should not be booked. Do I make an adjustment for that for working out CSR? I think that's something which we need to go forward and look at. But looks like that you have to take figures only on the balance sheet or P&L value and not make any adjustment for what the auditor has made a qualification. Some examples of how companies could be covered. Say you have a company 1 which has a net profit before tax, and for our discussion let's keep it at before tax everywhere. Net profit before tax of 6 crores, turnover of 60 and net worth of 500. It is covered on two counts. Profit is more than 5 crores, net worth is more than 500 crores. CSR is applicable. Company 2, net profit 4 crores, so not covered. Turnover 900, below 1000, not covered. Net worth is 400, of which revaluation is 300. So in this case, anyway, net worth is less than 500, so not covered. But assuming it was 500, in this case, yet it would not be covered because revaluation also needs to be excluded. So then the net worth would be 200 or 100, depending on which would be the case. Company 3 is a real estate company. Now here you have the guidance note of 2012 issued by the Institute on Revenue Recognition, which allows you to postpone revenue recognition even on percentage completion till 3 conditions are met of cost of construction, agreement for sale and realization from those agreements for sale. Now assuming you have not yet reached your threshold for revenue recognition, then my turnover would be nil. My net profit obviously will be nil. I just have a net worth which may be share premium and which may be capital. In such case, till my revenue is not recognized and I don't reach the criteria under the CSR guidelines, read with my ICAI guidance note, I don't need to provide for CSR. So that's something which real estate SPVs may find it beneficial. And company 4, this is an interesting scenario. Profit before tax 5 crores, but profit after tax 4 crores. Not being covered under the turnover or the net worth criteria. Is he covered? Is such a company covered? Now that depends on what interpretation we take, whether profit should be PBT or PAT. If we take PAT, he is out of CSR. If we take PBT, he is in CSR.
What is your opinion?
I believe, as I have said, it should be PBT, profit before tax. And as we will see elsewhere, for computing CSR, they have expressly said PBT. And the draft rule said PBT. The ICAI guidance note on tax audit says net profit means PBT. I believe everything said and done, it should be PBT. But that's something where we should hope for a clarification, as they are known to be doing. Removal of difficulties order, as they popularly call it.
So then the CSR will be on top of tax.
Oh, of course.
It will be 33% plus 2%.
I didn't get the top of that. Whether it would, are you asking whether it would be tax deductible or not?
No, not. It is, there is a tax payment and there is a CSR payment.
Yes, they are separate. This is not a tax.
And it will be before tax, it means again it is sitting on top of tax.
Yes. But whether it will be deductible or not is another question, which will come towards the end of the presentation.
Activity will be covered by section 37.
But it's not that clear cut. In fact, the earlier rule said that the draft rule said that CBDT will prescribe guidelines for tax deductibility. Final rules have done away with that.
The politicians will approach the companies that you control the companies.
Now these thresholds are to be examined during a financial year. So say I have a net profit before tax for period ended 31st December 2014 at 5 crores. In my last quarter, I make a loss, which drags my PBT down to 4 crores. Is CSR applicable for 14-15? Now, should I look at it at any point of time, or should I look at it at the end of the financial year? The words used are during any financial year and not at during any point of the financial year. Hence, in my view, the turnover and the profit should be looked at the end of the financial year, that is on 31st March 2014, 15 in this case, and not at any point of time. So if during the year you cross, that's okay, but at the end, if you have not crossed, then you would not be covered. This is something again on which there is no express clarity. I am expressing my view. I believe it should be at the end of the financial year. If you cross 5 crores or you cross 1000 crores, only then you are covered within the ambit of CSR. What about net worth, which is on a given date? Because net worth is not for a period, it's on a given date. Do I look at net worth as on a date, or do I look at again net worth on 31/3? Now if I look at profit on 31/3, it stands to reason net worth also should be on 31/3, because you will include the profit in that net worth computation. Hence in my view, all three should be examined at the end of the financial year. Only then would you be covered. But you need to keep a tab on it, because you obviously can't start spending on 31st only. Then you come to know on 31st that I've reached 5 crores and now I need to spend everything in the next few hours. That's not going to happen. So you going to need to have a call. The problem will be in those cases which are on the borderline. Do they spend or do they not spend? In a case where they don't actually want to spend, but they are being forced to spend. So say I'm at 4.5 and I don't know whether I'll touch 5. Then do I start spending, or then on the last day do I just go and give a check to the Prime Minister's Relief Fund and end of matter? So that's why they've given the Prime Minister's Relief Fund escape route, that when all fails, he is the lender of the last resort.
Sir, ideally spending should have take place in the next year.
Ideally it should, but then the thresholds need to be revised to say preceding financial year. They are saying at any time point of during the financial year. So they have not, for computation of average net profit, they have looked at preceding, but for spending threshold they are saying current. So that is right what you are saying. Now CSR criteria. This is a question which has often been asked. Is it a one-way street? Only exit, no entry. Only entry, no exit. Once you are covered forever. Answer is yes, but there are certain escape routes. Once you meet the 1/3 conditions, is CSR applicable forever? If threshold is breached during any financial year, CSR is applicable forever. There is no exit. But there is a gateway in two situations. Once covered, there is a relaxation if you do not meet these 1 by 3 conditions for 3 consecutive financial years. So if for 3 consecutive financial years you neither comply with turnover, nor with profit, nor with net worth, then you don't need to meet the CSR conditions. Or if your average net profit on which you pay 2% is a loss, then obviously you don't require to pay CSR. Otherwise, if supposing in this year I have a loss, but my average net profit is a profit, then I'm yet supposed to contribute to CSR. So that means I increase my loss. So this year I made a 1 crore loss, but because of past bounties, my average net profit for 3 years is 5 crores. I yet have to contribute 2% of 5 crores and increase my 1 crore loss to buy that. So that's a very, obnoxious provision. How can you ask a loss-making company to do charity? So let us just look at an example of this. There is some errors in the handout which you have got. So we'll give you the correct one. This is the right one. So say 2014-15, because that's the first year. Profit before tax, that's the first column, is 5 crores. Turnover is 50 and net worth is 100. Is it covered within CSR? Yes, because profit is exceeded. 3 years average profit is 4 crores. What is the CSR? 2% of 4 crores, 8 lakhs. Next year, I make a loss and I'm not covered within any of the 3 conditions, because 4 crore loss, 20 crores turnover, 100 crores net worth. Yet, I have to pay 2% of my average net profit, which is 4.66. So I have to pay 9 lakhs CSR. So my 4 crores loss goes up by 9 lakhs. Third year, again same scenario, but yet my average is a positive figure. So I pay 2% CSR of that is 3 lakhs. Come to the next, that is 2017-18. Here, there is a 2 crore loss, turnover is 10 and net worth is 96. Here, my average is also negative, and if I look at it, for 3 consecutive years I have not complied with conditions, hence no CSR. Same in the next year, and in the third year, although I am covered within the CSR because my profit before tax is 6 crores, because my average net profit is a loss figure, that is 2 crores negative, I don't pay any CSR in that. Again in the year after that, in the final 2020, I am back to paying CSR. So in 2 scenarios, I have an escape route. Either I 3 years consecutively get out of the 1 by 3, or my average net profit on which I have to compute 2% is a negative figure, in which case again I don't pay 2%. So any of one of 2 you meet, or both, you are out of the purview. CSR is mandatory for a company, its holding company, its subsidiary, its joint venture, and its associate. All those companies, whether they are part of a group or not, which comply with the conditions, required to comply with individually. And they can't say just because my parent has complied with, I am out of the purview. Mahindra & Mahindra has 143 subsidiaries, joint ventures and associates, most of which I think would be covered. So in that case, they all can't say M&M Limited is doing CSR, hence 142 will be out of it. No, all of them will have to go through the 2% route, and they can't look at a group net worth, they can't look at a consolidated net worth, consolidated balance sheet. They have to look at it on a standalone individual balance sheet, provided they comply with the 1 by 3 condition. Next important thing, who implements and takes responsibility for this? So it's the CSR committee. Yeah.
Sir, in this case, in 15-16, why did you pay a 9 lakh rupees of CSR?
Excuse me. 4.66, average 3 years net.
Net worth is below 500 crores.
Yep.
My turnover is below.
I am outside the purview, but yet my average net profit is a positive figure. Yet I have to pay. Because once covered, always covered, till your average net profit is a positive figure.
Okay. There is 4 criteria. 3 criteria.
3 criteria are actually given. 4th one is by default. Because there is no exit. That's what I said in the beginning, that even if you are a loss-making company, you have to pay. So my loss goes up from 4 crores to 4 crores 9 lakhs, which is a totally ridiculous scenario to be looking at. And that is exactly what Mr. Premji was saying, that in a time when India is going through recession, when so many companies are making losses, you are thrusting your socialist responsibilities upon us. So it's not social responsibility, it's socialist responsibility.
3 years average profit you have calculated on the past year.
Past also, yes.
Paying today.
The first block will be 11, 12, 12, 13, 13, 14. So starting from 1st April, the block will be 11, 12, 12, 13, 13, 14. So I have taken that into account, yes. Not current year, preceding 3-year block. It's like block assessment. Only 6 has become 3. So now you need a CSR committee. So that's to implement the CSR guidelines. First, the committee should be constituted from out of the board of directors. So only board of directors could be on the committee. You cannot have anyone else with CSR. The rest could be vice presidents and all who could be assisting the committee. But the committee must comprise only out of the board of directors. One independent director is a must on the CSR committee. You can have more also. And the report of the board of directors must disclose the composition of the CSR committee. Now, if I am an unlisted or a private limited company and I have no independent director requirement, then how do I have a CSR committee? Because I am yet covered within CSR. Here the rules now specify that you can have a CSR committee without an independent director. This is again another example of delegated legislation overstepping the legislation. When the Act says you need an independent director, how can the rules provide a relaxation? But of course it's something beneficial, so who's going to complain? It's, the company is not going to complain, the ROC is not going to complain. So who has a grievance? It's only somebody who's an academician like us sitting in a conference like this who would say that how can you have delegated legislation overstepping? But otherwise, if you go to look at it, how can rules take away something which the Act mandates you to do when the Act does not give you the power to do so? What if you are a private company which has only 2 directors, but the section requires you to have 3 directors? Here again, rules say you can have a CSR committee with only 2 directors, you don't need to have 3 directors. Can I have a CSR committee only of independent directors? Answer is yes, because it says only minimum 1. But the question is, if you have only independent directors, who will carry it out into effect? So it's always advisable to have at least 1 full-time director or managing director to carry it out into effect. You can have more than 1 ID, but better have at least 1 full-time director. What is the role of the CSR committee? FRM. Formulate, recommend, monitor. Formulate the CSR policy out of the specified activities. Recommend the expense to be incurred by the company on the CSR activities, and monitor whether the expenditure is being spent in accordance with the CSR policy of the company. This is the role of the CSR committee. Formulate, recommend, monitor. So they need to check and first think of a plan, then recommend to the board will take a decision, and then ultimately monitor whether it is in accordance with the policy.